The impact would be minimal, mainly because from the economy point of view, it is very positive in my view. The trade deficit between China is approximately $50 billion. That would definitely would have come down because of the less imports from China in the recent past. And also it is going to bring into the limelight of India manufacturing. A lot of foreign companies which are having the base in China, they will start rethinking, to diversify the risk of supply chain, and India will definitely score on this regard at a point where we have cut the taxation significantly to 17%. Earlier corporate tax has been around 25%. Now we have brought down that to 17%, which is in sync with the global tax rates. Secondly, the crude oil price have corrected massively, which also be beneficial for Indian economy, because India is a user of all commodities, including oil, crude oil. Companies will have at least 1.5 to 2 months inventory, which is being imported from China. For even if there is a stock out because of Chinese disruption in manufacturing, and many people not being able to resume the factories for work, I don't think it is going to impact, because February 1st onwards, next 2 months means March and April. By April, everything will streamline. All together, I don't think it is having a material impact on India. Some of the Indian companies will be beneficiaries of the low commodity prices. So we have to look at companies which are going to use the commodities in a big way, and the low prices of commodities will be actually benefit to Indian companies. So that also has to be taken into consideration. So if the brand is there and they are able to pass on the cost, then the margin can actually improve for those kind of companies and sectors. We are a significant buyer. Whatever AUM we have collected in the recent past in small caps and multi-cap funds and balance advantage funds, we have been fully deploying it, because whenever there is a scare in the market, and which we think it is not a fundamental scare, it is more of a technical scare which is there in the market, that is a brilliant opportunity to invest in the equities. When this dies down, the scare dies down, I think the markets will be much higher than what it is today. India has fallen lesser than compared to many global markets. So FIs have been selling. That is because of suddenly when you see there is a scare, obviously FIs are sellers. And historically speaking, whenever FIs have sold massively, and if you have participated in that as a domestic fund house, if you have participated in that buying against those FIs selling, you have always benefited. We think that this is the best time to invest in the equities, and we think that the fundamentals are only improving, economic situation is improving. As a house, what we believe is that we are bottom of the economic cycle, and interest rates also has come off, which is very conducive for equities. When interest rates are extremely low situation or low point of the period, that is not the time to invest into debt or duration bonds. If you look at gold, it is at an all-time high because of the scare and safe haven status. So overall, I am not a believer of either gold or real estate or even debt, and I think equity is an asset class where you have to put in money. Majority of the sectors, apart from FMCG and the consumer finance businesses, all of them are trading at extremely low growth rates, as well as maybe decade low or 2-decade low growth rates and valuations, which is not the time to worry about equity market investing. I think fabulous time to think a little bit long term and invest into this scare. Auto ancillaries, because the growth is almost at a 20-year low growth rates. Tractors already started growing. The YOY growth rate in tractor segment has improved to this particular month. For example, it has moved by 18.5% growth, which has been displayed, whereas it was degrowing. It was reported like minus 40% kind of growth rate. For tractor segment is already improving. Commercial vehicles will start improving, and also the entire two-wheeler and four-wheeler pack will start improving. So I think auto ancillary becomes one of the best picks according to me. Secondly, corporate banks, again, the credit growth is at extremely low situation, and non-performing loans have been, the companies were struggling with the non-performing loans, which is anyway at the peak situation, and it started reviving. The largest private bank which reported results last quarter is showcased that the provisioning is coming down and recovery is increasing, and still they are able to maintain the provision coverage fairly well at 75-76%. So there again, I believe that there is a huge earnings growth possibility which is visible in the next 3-4 years. Looking at some of the consumer durable names, looking very attractive. Some of them have not moved up at all in the last 2 years, 3 years. It has been consolidating. Those companies can be looked at because they are the beneficiaries of the low commodity prices also. FMCG is one sector which I will not be very gung-ho about because the valuations are extremely expensive, and some of the commodity companies which are again China specific scare is there. A lot of stocks are trading at maybe decade low valuations, which again looks very interesting. Ferrous and metals in that regard, and even some of the energy companies and utilities companies are very attractive. Pharmaceuticals is one sector which we think it is very, again, it is trading at some 9-10 year low valuations, and the growth is also missing. Therefore, people are not willing to bet on them. Whereas they are very good structural stories to buy into it. Infrastructure, capital goods, and real estate, those are the sectors, real estate stocks, are the ones which again needs an attention because that segment also is beneficiaries of low interest rate scenarios. So I am a big believer that in the next 3 years, Nifty itself can give double-digit returns, CAGR returns, and maybe within equities, I believe small caps looking extremely attractive, especially in the segments which I mentioned, excluding FMCG and consumer financing businesses. Small caps and mid caps has benefited a lot in terms of our performance against large caps. That is mainly because the valuation comfort there. And if you see even today, when people were talking about mid caps, and we have been telling this, and we have collected small cap AUM also from the market. People were concerned about investing into it, and that is one of the reasons the underperformance in small caps is clearly visible. That means that nobody has been investing even though they were watching it. 50 to 60% underperformance is what you will see against large caps with regard to mid and small caps, and that has been small cap index underperforming by 50 to 60%. It doesn't happen very often, and when you see that, that the scare is there in small cap segment, and that is one of the things which we have been monitoring. When there is in a particular equity segment, if there is a huge sell-off and there is a lot of pessimism around, and also the valuation is extremely attractive, and you see the earnings growth visibility in many of the sectors and stocks, and that is when you have to buy into small caps. The small cap journey has just started, and it is a long way to go. It is not a 1-day, 5-day game. It is a 3 to 4 years game. You have to look at the fundamentals, you have to look at the valuations, and you have to look at the earnings growth trajectory. In all three sense, I think small caps stand tall, and that is a space where I am suggesting all our investors to invest into it.